Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Josef Schachter, founder of the Schachter Energy Report online at SchachterEnergyReport.ca. He's speaking to us from Calgary. Joseph, people are worried about the ship stuck in the Suez Canal. It's not an oil tanker, it's a container ship. But there is a long line of tankers stuck behind it, maybe 100 of them or so. They're not sure how long it will take to get this 220,000-ton ship out from the walls of the Suez Canal. Is this really going to have much of an influence on oil prices?
Well, yesterday when it happened, the price of oil went up about $3 to about 61. And everyone was concerned about it, but there's been more and more information coming out that their tugboats they're bringing in, and they're bringing in ability to move the sand. They're waiting for high tide so that they'll have more water under it. They could also maybe take some of the containers off of it. So by Monday, Tuesday, the commentary I'm seeing today is that it'll be resolved. And so what we're seeing is the price of crude oil back off about $3 to $58.30 as we're speaking, and my view has always been that the near term, the price of oil was heading lower because the demand was not as strong as the optimists had expected. Again, Europe with the additional lockdowns we're seeing, U.S. demand is not as strong as expected. Remember, a year ago we were in the midst of the worst of the beginning of the COVID, where people were just shutting down everything. So the demand this week in the U.S. EIA report that came out on yesterday, was 18.7 million barrels a day of consumption. That's down from 19.4 a year ago when we were already in COVID, so 718,000 less. The other thing is U.S. consumption, U.S. product has come back from 9.7 to 11 million, up 100,000 just last week, and I think we're going to bring back another million. And then in the 4 weeks that we've had of storage build, the total is almost 40 million, 39.7 is the exact number of build in U.S. inventories. And normally at this time of year into June, you see a normal build. And then, of course, the summer, if we have an active summer driving season, a lot of that gets used up. This year, question mark, will we see herd immunity enough? So the demand issue is one problem. The inventory situation build is another problem. And third, OPEC cheating, where a number of the countries in there, Iran, Iraq, Nigeria, and others, are producing above their quota. And so the amount that's been taken out by Saudi Arabia is more than offset between half of it is by OPEC cheating, and then, of course, the United States production coming back as fast as it has is hurting the pricing. And my guess is, and my expectation is, that we will see sub-$50 WTI in the April-May period, and the index will probably, the S&P TSX Energy Index, still has quite a bit of downside. So in January, February, and then again in March, we repeated sell, and the sector has done extremely well since March of 2020 when we put out the buy signal, if you recall, and I'm still in sell mode, and not that we have much left because we did sell quite a bit, and I'm waiting for the next buying opportunity, which I think will be at much lower levels, both for the stock price and the price of oil.
How much is OPEC cheating, and how much of a factor is that?
Well, the data is quite something. The OPEC report that came out in March showed the Saudis, which were supposedly having cut back by 1 million barrels only cut back by 930,000. So, not a big difference, but they were producing 8.15 million. But Nigeria raised production by 161,000, Libya by 33, Iraq by 59, Iran by 35, Venezuela by 33. So the net was only a decline of 640,000 versus the assumption there would be 1 million cut back. And then you take into account the United States going from 9.7 million to 11 million. That's you're talking 1.3 million of additional production, more than offsets just what the Saudis had done. So to me, there is sufficient oil out there. We're now seeing the IMF and the IEA say that, and there's been reports out talking about demand being only 94 million. If you remember pre-COVID or January of 2020, we were about 101, 102.
We'll have more with Josef Schachter right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Josef Schachter. How is U.S. production doing, and how big a hit was the big Texas ice storm?
Well, the Texas ice storm really knocked off production between the prices coming down. We were about 13 million before crude prices fell in 2020. We were about 13.1, 13.2, I believe, in January. And now, as I mentioned, we're 11 million at the low during the worst of the storm, when most of the fields were shut in because of no electricity, no ability to move the product. We were down at 9.7 million barrels. The U.S. last week, the EIA on Wednesday reported 11 million, up 100,000 on the week. My expectation is we're probably going to get up another million between now and the summer, because the drilling activity in the Permian and the Eagle Ford has picked up quite a bit, and there's a lot of drilling going on. And it's interesting, when you hear the reports from the large multinational, large big public companies, they're all talking about restraint and focusing on shareholder returns and not growing their production. But the private companies and the private equity-backed companies are the most active drillers. They're 40-50% of activity in some of these basins. And their view is, when they wanted to buy us out at the crazy prices 2 years ago, we sold it to them, and then we started a new company. Now we're growing because we don't have competition from the big boys, and we can buy land, we can get drilling equipment cheap. And so these guys, these private-related guys, are the ones building up the businesses very quickly, and they're the ones that are bringing on the new volumes. And so my view is I think we'll see 12 million barrels a day from the U.S. sometime this summer. And that will more than offset potentially any new demand, assuming we do see more herd immunity comfort in the States. And long term, the shales require a lot of drilling repetitively because of the high decline rates. These private companies, if they get prices in the $50, $60 range, they can keep on drilling. If I'm right and we break 50, that would be the thing that would slow the industry down and maybe not get us to that 13 million. But with prices where they are right now, $58, that's very lucrative to these companies.
We'll have more with Josef Schachter right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Josef Schachter. Joseph, do you remain bearish? And if you are, for how long?
I think the issue is twofold. One, when do we get to herd immunity where we can all feel comfortable and be more, increasing our use of transportation and travel, going out to activities and things like that. And I think that's probably Q3, Q4. Versus Q2. So, I'm in the bear camp, and I think right now this inventory build, is quite substantial, as I mentioned with the numbers earlier. And the run up to $68 was twofold. It was one, a lot of speculative commodity futures buyers, including the Robinhood Reddit crowd that joined in and bought options and futures. But it was also the Saudi announcement of the 1 million barrel cutback, which everybody thought was going to have was going to be there with and that you pull back that much production and demand was going to recover in Q2. That was March, April, and or February, March, April, when they said they were going to cut back for the 3 months. The bottom line is the demand recovery has not happened. U.S. inventories are high. U.S. production is growing again. So there was a mistake made. I think we're going to, like anything, you go from overpriced to underpriced. I think we're going to see 68 turn into 48, maybe even 44 to 48 at the bottom sometime in April, May. And if we see the stocks come down cheap enough, that's when I think we might get another buy signal, and we would then turn back to being bulls again. I'm bullish longer term because I think that because of the lack of capital investment worldwide, once we get back to normal, i.e., herd immunity, and we get back to 101 million barrels of consumption, the industry is not spending enough to replace the decline rates, and that will mean you'll need to have much higher prices to provide the capital to increase drilling. And with a lot of companies focused on shareholder returns, that's going to take a bit of time before they're going to be willing to put more money back in the ground. So I'm looking at potentially $70 oil in 2022, and in 2024, 25, I think we'll see $100 sustainably. But in the meantime, swings can happen of overbought, oversold. Last year in March, we were extremely oversold. First quarter of 2021, we're overbought. I think Q2, Q3 will be oversold again, somewhere in the mid 40s to low 40s.
Are there any concerns that we have people like Vancouver City Council demanding that oil and gas production and exploration stop this very minute?
First thing, are you going to stop driving? Are you going to buy an electric car? What about the buses? What about the trucks on the street? What about the ships? Bringing the cruise ships in. I think the assumption that use that we're all going to go immediately to electric vehicles, electric trucks, electric cruise ships. I think that's totally decades away at the earliest. So even though they may want it, it ain't going to happen. And let's see them be the first ones to do it. If they're going to stand on a pedestal and say we're going to be not using fossil fuels, being a great example of it by doing it yourself. And the reality is they can't. So they can talk the talk, but they can't walk the walk. I think it's total bullshit.
Is there a plastics shortage? Our good friend Wolf Richter said it's hurting automobile production around the world because the Texas deep freeze also slowed the production of plastics there.
Well, there's the many of the industries are impacted more by the technology, the chips from Taiwan semiconductor, but the refineries have not come back to the utilization rates that they were at. I think the utilization last week was about 81% for the refineries. It was up from 74 the week before, but it's still down from 87% the year before. So the refineries are getting back power. They're starting to get back, but they're going to produce the highest value products first, and then go to others. So yes, there may be shortages of some items, but given the refineries are getting back to almost the normal level of utilization, I think that it's a short-term problem, not a long-term problem.
You're expanding research coverage to pipelines and infrastructure stocks. Can you tell us how you plan to do that exactly?
Yeah, we've been covering energy and energy service stocks since 2017 when we started the product in April 2017. And we've been getting a lot of people who are asking us, can you cover the pipelines and infrastructure stocks because we need dividend income. And the problem you have in the street is that, there's not a lot of research available to individual investors, especially those who are using internet brokers and, wanting the low cost of transactions. So we've been asked to take a look at those and cover them. So we're going to break our research down into conservative, growth, and entrepreneurial going forward. And in the conservative section, we do have a few energy companies that pay dividends and that are larger and have very strong balance sheets, and they'll fit into that conservative section because they have the dividend yield and the strong balance sheet. But we're going to now cover 5 pipelines and infrastructure stocks. We'll introduce coverage on them in our April SER Monthly, which will be coming out on Thursday, April 22nd. So, if investors, would like to have independent research on the sector, they should go to our website and look at the options to subscribe.
And how can people get access to your research?
We have a free product which is called Ion Energy, and they can go to www.schachterenergyreport.ca. And there, under the subscription page, they have this Ion Energy, which we do a free weekly macro piece talking about what's going on in the oil and gas industry, why I think the prices are moving, what's going on with drilling activity, and what our view of the overview is. And then the subscription product is either a quarterly product or an annual product. And if you remember, a number of months ago, we gave a special offer through the group. We may do that at some point in the future, but right now the people should just go to the website and to feel and get a feel for the product. They can go and just get a quarterly subscription, and then if it meets their needs, then just renew the quarterly or move to the annual, which is better by the annual value.
Joseph, thank you so much for chatting with us.
My pleasure as always.
My guest has been Josef Schachter, founder of the Schachter Energy Report, online at schachterenergyreport.ca. He was speaking to us from Calgary. And that is the end of our show. We'd like to thank you for listening. If you have any questions for Joseph or any other of our guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.